Doesn't start
seconds.
it, so.
Well, I don't want to, someone might want to come in. I don't want to jump the gun here.
Oh.
We're posted for 6 p.m.
Yeah,
Yes, we are.
and people are gonna know if it's 6 or
Mhm.
just face it.
Okay. Call this meeting to order. Let the record show that all council members are present who attend with the pledge of allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice. Um, additions to the agenda, we want to put the dehumidifier under unfinished business or?
Yeah, did you want Chris to be present for that? Or?
Yeah, we should have Chris here. Is there anything else to add to the,
No.
is there a motion to approve?
No move.
Second,
Second.
all in favor say aye.
Aye.
Aye. Motion carried. In your packet are the minutes of the regular meeting of July 24, 2025.
Regular meeting, not one.
Was special because we purchased it on Thursday.
That's right. It was a special meeting.
It's regular business.
Right.
Special day. Anyway, are there any additions, corrections, or questions regarding those minutes? Hearing none, those then stand approved as printed. We'll go on to the claims, and there is a sheet with a number of last minute ones.
What do we have for the concrete at Gullard? What do you do there?
Benches.
Oh, yeah.
Any questions or comments on any of those? We have a motion to approve.
So move.
Second,
Second.
any further discussion? If not, all in favor say aye.
Aye.
Opposed, no. Motion carried. Notices and communications, or is this thing for the regional meeting for the coalition, but it's during the fair? I guess we'll figure it out.
They're asking for people to sign up by like the end of the day tomorrow. So if you want to participate, let me know as soon as possible.
Yeah, I'd like to go, but not during the fair, unfortunately.
I think that's probably everyone's answer. Unfortunately.
Okay. Anything else for notices and communications?
No, I'll do that.
Okay, then we'll pending this is before your call.
Yes. Electric utility updates. Blake and Chris and myself spoke with Walker Orenstein. Walker is an energy reporter for the state of Minnesota for the Star Tribune. We, between a little field trip and meeting in my office, it was over 2 hours of discussion. Really, really good, really well. All three of us said that. So I just texted him prior to the start of the meeting, and he texted back just now and said looking at a Thursday for the digital version of the story online, and then print Friday, Saturday, or Sunday. So it'll be he's gonna do a fact check call with me on Wednesday and button everything up, and yeah, so looking forward to seeing that.
Sounds good.
As a, which anybody else can listen to, as an interesting photo op, he had asked for different things or whatever. A lot of the stuff's been fixed, but then all of a sudden it came to my mind that they have been waiting for an unreasonable amount of time to get the electricity on at the Catalyst building. So they snapped some pictures. They were going to we expressed our frustrations on that. So whether that gets done before the fair, I'm not sure. But wires just sitting there on the ground. It would take all a half an hour to hook it up. So that was part of our little road trip that we took.
Month and a half. It's verified with the trip.
Month and a half.
It's been letter F, Wonder World Community Meeting. Kate and I went to that last night. There was large attendance, unfortunately, but it was good content, and they went through a little bit more detail of their building design and then specifically where their funding picture is at right now and what the plan is moving forward. And I guess the big takeaway that I had was that they have a somewhat of an agreement that if they have some progress made by April 1st of 2026, that an extension would be considered until July of 27, which is a year longer than the current executed lease. So that's their big goal, is to have progress. Progress, they don't, is defined not explicitly right now, but it is to say that they know that it's physical building progress that is not defined as fiscal progress and fundraising. So they want some dirt moved, is what they've been told. So that's where they're at. I don't know if you would.
You know, I appreciated the work that they put into the revisions that they made to the proposed building, in that they changed the roof line to, you know, reduce the cost of it. They did some things that I thought were, you know, really responsible on their part to help reduce the, you know, the estimated cost for the project. So I thought that was a positive.
Yeah, for the benefit of the council and anybody listening now or on YouTube later, their original estimate from that building firm that had worked on a couple of local projects was north of $3 million. I think it was $3.4 million. And that board, the Wonderworld board, has spent many an hour trying to get local contractors to give them, you know, actual not a bid, but an estimate for what it would take to do the project. And they're at 2.1 right now is the estimated project cost. So
That's a significant reduction.
yes. So that is their fundraising goal, is 2.1, of which they have about 650,000 committed to the project right now, between our 225, their 200, the capital campaign has 25, and then what's the other?
EDA for the county.
Yes, the $100,000 from Green County.
And they're, you know, going to be ramping up the capital campaign now to really push forward with getting fundraising in place here. So, and I think they needed to dial it down and to get the details, you know, a little bit more nailed down with the project, and you know, for people to understand that they're working hard for that, and so they can, you know, see what the real numbers look like they might be. So that was positive.
Yeah.
Anything else on there? Anything else impending?
Nope.
All right, we're gonna jump ahead to new business and let you talk to us about the audit.
All right, so just as it's always been, we come here with your drafted financials because of the one, you guys approving it, and then also the suggested transfer, usually from your general fund to your capital outlay. So the front of your guys' draft, you can see just my handwritten notes, since we don't come here with your final. These are a few of the things that you will see in the final one. So there are two different types of reports that go out in your single audit. There is your Minnesota legal compliance report, and then your report over internal control. So as far as Minnesota legal compliance violations, we noted two instances. One, that there was two checks written outside of the 35-day window without interest added. Josh and I did discuss the two invoices in particular. One being Dickinson Contracting, and we kind of deduced that maybe the invoice was initially an estimate with a date on the top corner, and then the actual invoice, when it was sent, the date was never changed because the estimate date and the invoice date were the exact same. So kind of out your guys' control there when a contractor doesn't change the date on it. Also, then there was one to Scarcely. So DSI is doing your guys' small cities development, and you guys have DSI request a drawdown from the state. The state gives you your money. Once you guys get the money, you cut the checks to those vendors. I don't know if it was a DSI problem or what happened there, but the invoice was in January. The drawdown happened in April. So it's kind of out of your guys' control if your drawdown didn't occur. But again, compliance is compliance. So I guess I work with DSI a little bit more on that and saying that you guys need to get those bills paid within that 35-day window. But like I was telling Josh, the likelihood of a company would be they are going to add their own interest and penalties and rebill it again if they plan to. So I don't know, it's kind of scarcely as well. The other being the Fire Relief Association receives state aid to you guys through the city, and then the city is supposed to reimburse that to the Relief Association within 30 days of that receipt. That was not remitted for like 2 months, a little over 60 some days. That one, like I said to Josh, is kind of hard as well because that comes in EFT'd. So it's not like a physical check came here. He knew I need to go make this deposit at the bank. So I'm not going to make excuses for Josh either, but I'm just saying that I think if it came in a check form to you guys versus EFT, it'd be a little bit more noticeable to cut that back to the Relief Association. But just to know what it just was late. The 4 internal control deficiencies, 1, 2, and 3 are pretty much on every single one of our audits, and you guys have seen them in the past as well. Just that you're unable to prepare the financial report without auditor assistance. You guys ideally are supposed to be able to do that yourself. I don't have a single client who doesn't have that right up. The lack of proper segregation of duties, that one is just due to the size of your guys' city. So just having 2 people in the accounting functions, ideally you guys would have 4, 5, 6. But that is not feasible in a small city or a small business. So that I have on virtually all of our audit clients. Material adjustments were made by the auditors. I'm not going to say I have it on every client because I do have some clients who have very, very clean books and or they have very, very well established bookkeepers. But 95% of my clients have material adjustments made by us. So that is a deficiency. We are not supposed to make material adjustments for you. And then the one that's not normal, I guess you could say, with bank reconciliations are not being done in timely manners on occasion. So we also discussed that. There was a couple months that I noted, it was like March and April wasn't done till June. July and August wasn't done until October. Ideally, the state says timely is within 15 days of the bank statement date. That being said, Josh said that they were probably done, just not printed till those dates. I said, print them when you do them then. That's my evidence. The other suggestion was then also, or the EDA was also not done. That was like 6 months at a, whatever, July, August, September, October, November, December, wasn't done until 2025. That one, he said he reviews the bank statement as it comes in. There's such little activity on it that he reviews it. If there's nothing really in it, he just shoves it in the binder, does it all at once. I just said, instead, then just make a note. Yep, I looked at this date, so that I too as well know that you're looking at your bank statements, just to make sure that something's not gone through that shouldn't go through there. And again, everything's evidence to us. So just because you say you did it doesn't mean you did it. Date initial say you did it. And then also the small cities development account, which literally has had no activity in it, I think, since I've taken on your guys' audit. That one had no bank reconciliations done on it whatsoever. He said it's not set up as a bank account in your guys' thing. Right. To be able to do bank reconciliations, I said then do manual bank reconciliations and or same thing, date initial, say you looked at it, that there was no activity running through it. But so all of it's been discussed with Josh. Yeah, it's just kind of a slap on the back of the hand and make sure you're doing those in a timely manner so you guys can catch anything. So I said those are your internal control deficiencies. Getting to the numbers, the fun stuff. The next page, then page 56 is on the top there at the start of your general fund balance sheet. I did make notes next to everything, so you can see me kind of skipping through it, maybe because I didn't find it very important, but just for your benefit, I wrote notes next to it in case you're looking at it in your own time. But assets for 2024 were $1,252,584. Prior year was $1,129,488. Some of your larger fluctuations. So overall, between your cash on hand, cash and checking, cash and savings, and your CDs, overall the cash increased in your general fund $130,888. That's stemming from the profit in the general fund this year. You can you'll note it throughout all of the funds, but last year there was money in CDs. This year there is mainly just sitting in the checking account at year end. Discuss that with Josh as well, just making sure that if you have excess cash, to make sure it's getting invested in some way or another, earning interest, because you'll see throughout the financials that interest income is actually down this year because there's less money sitting in interest bearing accounts throughout the year. So that's one thing we discussed.
Most of that was due to the fact that we needed the cash for some of our larger projects, like before the bond funding came in, and like our 28th Street sidewalk. Now they'll be back in CDs now that we don't need that liquid cash.
Yep. The prepaid expenses, the only other thing I was really going to point out in your assets in in December, your guys' health insurance premium to PEEP get automatically withdrawn, and then Jackie accidentally paid that via check as well. So actually January 2025 health insurance premiums were paid twice in December. That got allocated to your January and February of 2025 stuff. So things were a little wonky in the insurance there at the end of the year, and just a manual mistake. Liabilities for 2024 are 100,679. The prior years were 116,343 total. Accounts payable, just that went down to 26,286 this year from the prior year's 50,000. The prior year there was all the lighting improvements and expansions at Guller Park for that Light Up Guller project, and so that was obviously not in 2024 since that was all done in 2023. And then your fund balance towards the bottom there then is for the 2024 is 1,150,436. The prior year's fund balance is 1,011,676. So that increase in there stems from your current year profit. And then my notes at the bottom is where I discuss that you guys normally transfer your excess funds here. So your minimum fund balance policy is 40% of the next year's operating expenses. So with that calculation, your minimum fund balance for next year needs to be 893,488. You can see your unassigned right now is at 1,119,623. So right now there's an excess above your minimum fund balance policy of 126,135. Like I said, you guys normally suggest to transfer that to capital outlay. You guys can make that decision once we get to it, but just know that that's where the excess funds are sitting right now, is in your unassigned general fund. Next page is the start of the income statement for the general fund then. Overall, the bottom of page 57 is your total revenues for 2024. So total revenues were budgeted for $2,934,705. Actual revenues came in at $2,591,497. So you had a negative variance with your budget there of $343,208. Within the sections, your property taxes increased this year from the prior year, just with your increase in levy for 2024. Intergovernmental revenues is kind of where your biggest fluctuation from your budget stemmed from. So overall, intergovernmental revenues was budgeted for $1,491,155. Actual came in at $1,110,632. So overall, a negative variance there of $380,523. So just various things within here, your small cities assistance, there was nothing budgeted for because in 2023 they did not allocate small cities assistance. Well, then they decided to reallocate that again from the state in 2024. So you guys received $36,076 in small cities assistance. The police relief aid and fire relief aid, they're kind of tough to budget. A lot of that, some of that stems from your normal relief aid, and then some of it stems from reimbursements from training and such. So overall, your state police aid was $60,486, which was $15,486 above budget, and your fire relief aid was $41,495, which was $11,495 above budget. The biggest variance with your budget then, your airport grants and aids was budgeted for the hangar rehab, and that was, the state never did end up approving or allocating you guys to do that project in 2024. So you'll see the revenues weren't there, but also the expenses weren't there. So overall, actual airport grants was $18,343. And that is, you guys get $15,556 or something along those lines.
15,569.
15,569 for an annual maintenance reimbursement. and the other part is from previous airport project approvals that just some trickling in bills that you're getting received or refunded for in 2024. Another thing not budgeted for was your FEMA. It's your federal aid there. There was nothing budgeted. You guys got 36,166 federal aid for FEMA, which was 75%, and that was all for 2024 flooding expenses. And then the other fluctuation is your other state grants and aids was budgeted for 87,343. The budget stemmed from public safety aid that you guys received in 2023. Like the small cities assistance, they gave you that public safety aid in 2023, but did not give you it in 2024. Every city across Minnesota. So that's where this big variance from your budget stems from. What is in there is mainly the 25% state portion of the FEMA aid that you guys received. Charges for services overall was budgeted for 98,528. Actual came in at 108,296. Biggest fluctuation from last year to this year would be in your zoning fees. Last year you had 16,000 in zoning fees. This year 7,694. The prior year you had zoning fees for the new county shop. This year your zoning fees stemmed from the Nobles County Electric building. So both years you're getting some pretty good revenues on zoning fees though. And then police contracted services, obviously that contract was done in 2023, so there is no revenues in there for 2024. Miscellaneous revenues, interest revenue on the top there, like I said, 6,347 this year. Last year's 10,581. Again, less invested in those interest bearing accounts. Your interest income is down. There was nothing budgeted in your other grant section. However, you received $10,000 from SMOC for a grant for the fan shelter roof. Contributions and donations, again, nothing budgeted for. However, 19,832 came in. Majority of that was for your Gullard Park equipment. Other big fluctuations from your budget, your cable franchise fees and PEG fees overall is budgeted for 26,000. That's actually dwindling each year too, as there are less services with Blue Peak and MediaCom these days, with cable getting kind of cut out of people's technology these days. And I just wanted to point out your insurance refunds and dividends actually increase. It's below budget, but it's actually higher than last year. League of Minnesota Cities issued a larger refund in fiscal year 2024 than they did in 2023. So that is your revenues in your general fund. Page 58 is the start of your expenses. General government for your legislation came in similar to budget in the prior year. Your executive section came in similar to the prior year and budget. Election and voter registration, you budgeted 5,306. Actual came in at 6,367. I just wanted to note in that section that your special election that you held for the Excel approval is not included. This is just your normal election. Your special election stuff is included in the miscellaneous category in here as we're tracking that for future reimbursement from the Excel or electric fund eventually one day. Financial administration, there's a few fluctuations in here. Overall, the budget was 175,898. Your actual came in at 197,326 for a negative variance in your financial administration of 21,428. The biggest part of that stemming from your salaries. So what happened here, it wasn't that Josh and Jackie got big old pay raises and you guys budgeted incorrectly, is that the budget was allocated 80% administration, 20% water for Josh, and 60% administration and 40% water for Jackie. However, the allocations in the payroll software were never changed. So actually 100% of Josh's salary got allocated to the general fund, and then 44% of Jackie's to the administrative, 43% to water, and 13% to PEG. So the budgeting versus the actual where the salaries are just in different spots. So I wanted to point that out to you.
Knowing into the year of 2024, and my logic for not changing it mid-year was not to make payroll even more of a hassle than it is at the end of the year. We'll have to get our stuff for W-2s. If there would have been a general fund deficit, I was going to do just like a journal entry, but 126 under budget, so we just decided to leave it alone. Have that one line item be looking like we're short. And it has been changed now. Both Jackie and ours are correct in our payroll system. So
they're back to the 60/40.
80/20 for me, and then Jackie's with that 13% peg or whatever she's.
Yeah, you said you didn't change Jackie, but you changed
Right.
Jean.
Yes.
Yeah, which I don't know. That's again your guys' future budgeting decisions. For us, for the audit, we don't necessarily care where things are getting spent out of in that aspect. So, just wanted to point out that's why your variance with your budget is there. But equipment repairs and maintenance in your financial administration, it is under budget. You budgeted 18,375. Actual is 12,417. The biggest thing I wanted to point out is it is up pretty significantly from last year. Last year was only $5,160, and a majority of that is you guys are paying some somewhat hefty fees for website management now. And then yeah, that's pretty much all that I really for financial administration. Professional services that as well is under budget. So you budgeted 62,000 total for professional services. Actual came in at 41,347. So you had a positive variance there by 20,653. City attorney is budgeted for 15,000. Actual was only 6,401. City engineering is budgeted for 5,000. However, there was none utilized. Independent and accounting and auditing was budgeted for 20,000. Actual came in at 13,479. And yeah, your other professional services budget for 2,000. Actual came in at 1,067. That other professional services last year 15,359. There was a compensation study done in 2023, and some of your website design was allocated in that category last year. So that's where some of the fluctuations from last year to this year stem from.
Wouldn't,
Go ahead, Kate.
question, you know, the upper one where the equipment repairs included the website management fees, wouldn't that be in professional services fees rather than equipment repairs?
So that was along the lines of my comments last question too, because we talked about when we met with Byron, is like I don't think the vast majority of that increase is the website. I think the vast majority of that increase is our new hosting. So is that for the Cassell or for accounting software? So is that in that? Do you happen to remember if that's in that equipment repairs?
Yeah, there's Cassell costs in there as well.
Those are way higher than priors. I would guess that's the majority of it.
And it depends on how you're paying those two. Like if you're paying it like monthly, we'll less likely to look at each and every individual monthly invoices versus one big one. But that stuff is stuff that I'm gonna call it. We're not the I don't know fun police is how I'm gonna call that one. I know that last year there was a lot of the fun police stuff going on, and this year I said I'm not doing it. So
Well, I mean, I'm just asking, you know, and I know maybe I'm the one that gets fussy about this, but I think things need to be placed in a category that makes sense for the expense or whatever it is. And if that's an ongoing fee to have a service, I don't view that as what it's listed under equipment repairs. That would be a professional service of services, and that's just my 2 cents. And I feel like. That's what I'll say.
I can look at it too, and that's not going to
No, I
affect
completely
anything in
agree.
this.
And we talked about that. I said that during our meeting.
We just said
at your
consistency in your
office.
coding. That's what I talked about.
Yeah.
And
So if it's there
adding-
1 year, to put it there the next year.
There's like one GL in the library that's like a 333 code for like fees paid. And that's where those like Plum Creek go. The things that we get a bill for every year or every month or there needs to be a 333 code for fees paid in every single department. Because we're getting more and like police have the Lexapol thing for all of his policy updates.
Right.
We have the Cell. We have Amelia now for our park, pool, and rec processing. So we're getting more and more of these every year.
We call them subscription-based technology is what we have them as like we discussed this at our meeting on Friday, but that putting a whole code system in there pretty much for your subscription-based technology would be helpful, because then you'd be able to see specifically just that, how much your software alone is costing you each year and how much it's
Because
increasing.
I don't even, it's truly a professional service, really. I mean, because I think when I think of professional service, at least in my time, that's been those big type of one-off things that we do.
Feasibility report.
Right. It's like fees paid is more of the day-to-day, month-to-month.
Yeah, it used to be, if you wanted to, physically bought the software.
Yeah.
And a server.
And if you used it for as many years as possible or whatever, it don't work. You're basically leasing it now. It's a subscription or a lease or whatever you want to call it. It's an ongoing, never-ending thing.
That's what we were talking about. So actually, new accounting standards is if you have a long-term contract with these subscription-based technologies, you're supposed to treat it like you own it. So just as if I bought QuickBooks back in 2015 and I still used it for 10 years, I had the asset for 10 years. Well, now QuickBooks has gone to annual payments for their stuff. So now if I lock in a price with my bookkeeping software for 5 years, I'm supposed to actually put it on there like I'm owning it for 5 years, and I have a liability sitting out there 5 years. You guys don't have quote unquote any super long-term contracts. Or Civics is your biggest one, and that's annual. That's an annual maintenance. So again, just moving that to a, like I said, we talked subscription-based technology and just moving those all together, because like I said, it's not really a repair. Josh said it's not really professional services. So it's just putting a new line item in going forward, so you guys can really track, hey, Civics and Amelia, and this is costing us this much each year. And you'd be surprised actually how much that probably is increasing every single year. These technologies are getting really expensive.
I wouldn't be surprised. That's why it needs to be its own sheet.
Yeah.
So we can
Well,
track the trend line.
And it's still not apples to apples if you compare it to the old software, because with the hosting that's covering your hardware costs too. So, it's, you know what I mean? Instead of having servers and maintaining them, which we'd have other professional services.
I would say you typically on those type of instances have, oh, this crashed, now I need to go pay this IT person, where now they're fixing it on their end. So
And then we'd also have OS licensing and maintenance.
yeah.
So the prudent thing, if we want to change something, is just wait till the beginning of fiscal year 26, right?
Yeah, and
So
we
we're
can
not
always pull them
changing
out.
something. Unless, or otherwise you could change all the codes for this year.
He could review
You mean,
them.
when you say this year for like what we're talking about now?
2025.
It would not be very difficult at all to change it for this year, because I'd just create the GL code, some of which I've already created, and then I would just journal entry the existing transactions into those new GL codes.
I'm fine with whatever.
I'm fine.
Because there's not that many of them.
So whatever it's easiest to do, I think it's better to have it reflect what it actually is. So and for tracking purposes for all of us.
Definitely for 2026, though, I think we want it.
So do for 2025 is actually that will help me for the 2026 budgeting process to be able to track.
Probably a good idea.
All right. So then the next category is your general government and building. The total finishes on the other side, but it's just noting that your repairs and maintenance in here is under budget, but it is higher than the previous year. And just note that your city hall drywall repairs and painting is in this category. Janitor was budgeted for 23,000. Actual came at 17,580 for a positive variance there, 5,420. Just noting there that actually you came in like pretty much spot on your budget, but 5,000 was actually paid out of the water fund for fiscal year 2024. So you actually did for janitorial services payable at 23,000. And then building and improvements, you had only budgeted 1,000 for, actual came in at 5,974, and that was for your heating and lighting at the senior center for 5,974, and I believe you had a rebate come in on the lighting side of things.
Yeah, the heating was an unexpected repair to budget. My follow-up question to that is, is a rebate, so it'd just be booked back against the expense within that line item?
It is not.
No, it would be in like other.
It's in other revenues.
Oh.
So that way it reflects the full cost of that lighting.
Got it.
So overall, next page then is where total general government finishes off there. So overall, your total general government was budgeted for 342,224. Actual came in at 335,368. So very similar to budget, just $6,856 below budget. Public safety is the next overall category, starting with police protection. Overall was budgeted for 698,974. Actual came in very similar to budget, 698,192. So you had a positive variance there of 782. There was some fluctuations within the categories. Salaries and wages was budgeted for 431,947. Actual was 446,960. So you did have a negative variance there with your salaries of $15,013. Office supplies as well was budgeted for 1,000. Actual came in 8,519, so a negative variance there of 7,519. You guys had to do a policy manual update for the law enforcement, and that was pretty hefty. I believe it was about $7,500 of that.
That'll be one of those ongoing costs. Not that amount, it's lesser. The initial cost is more, but there's an ongoing fee over the next 4 years. For that, so.
And then buildings and improvements budgeted 14,500, and you actually did not spend anything there, so that had a positive variance there, 14,500. It appeared to me that the budget was for the impound lot and some evidence room updates, and that ended up getting paid out of capital outlay instead of your general fund. Your ambulance protection was budgeted for 20,100. You actually spent nothing. I believe Josh and you guys have had that conversation about the counties not billing you guys for 23, 24, and then 25. They try to bill you for them all. And Josh did not pay all of it because he argued that or something along those lines. You guys had that discussion. So yeah, there's nothing there for 23 and 24, even though you budgeted for it. Fire protection overall is budgeted for 240,606. Actual is 230,438. So positive variance there of 10,168. In the category, there's a few with fluctuations. Biggest ones, remittance to the Fire Relief Association. So you budgeted 30,000 in revenues, you remit 30,000 in expenses to them. However, you actually had the revenues come in higher, and so what you have to remit to the Relief Association is also higher. So that was 44,495. So you had a negative variance there of 14,495. Your pension in the municipality or the city's portion. So the Relief Association is not fully funded, or is so you guys have the obligation to catch them up to be fully funded. So your obligation for 2024 was 30,968. You guys get that in your budget, and it's matching your budget because it's a number given to you in advance. So you guys should know next year's unfunded as well at this point. Supplies budgeted for 18,000. Actual came in at only 11,253. What I wanted to point out in your supplies line item is that last year at your guys' meeting with me, you increased your capitalization threshold to $2,500. So things that cost less than $2,500, instead of being equipment or capitalized stuff, now it's going under your supplies category. So because you increased that to 2,500, the Fire Relief Association's like boots and helmets, etc., all that stuff that used to be in your equipment is now being expensed under the supplies category. So that's why that's up from last year. Repairs and maintenance also was budgeted for 20,000. Actual came at 30,640. So there's a negative variance there of 10,640. There was quite a few trucks that needed repairs this past year and pumper repairs. So all that stuff in there was just repairs. There was, I think 4 or 5 different pretty costly repairs that had to go through there. Building improvements was 15,500 for budget. Actual came in at only 4,037. So positive variance there with your budget of 11,463. You guys budgeted for the entry door and locks for the fire hall, and I don't believe that was done in 2024. And then the equipment was budgeted for 31,560. Actual came in at 20,505. So you had a positive variance there of $11,055. A lot of that stuff that was budgeted for was just general property, plant, and equipment, and a lot of that stuff is now in supplies. So either way, it was under budget. However, it's even further under budget because of stuff being put up in that supplies category. What did get purchased this past year was some fire gear and a sprayer. Not gonna cover anything on zoning or animal control board, safety, etc. Public Works is the next category. Public Works overall was budgeted for 55,000. Actual came at 55,000. So not gonna cover anything there. Streets and alley is the next section in your public works. Overall, streets and alleys was budgeted for 438,105. Your actual came in at 381,733. So you had a positive variance there of 56,372 overall. Operating supplies, budgeted for 35,000. Actual came in at 40,116. So you did have a negative variance there of 5,116. And it is up from the prior year's 29,649, and there was just a large increase in your mosquito spraying costs. Just the spray itself costs increased very significantly, and then I think you guys were able to increase the times how many times you sprayed in 2024 as well. Equipment repairs was budgeted for 20,000. Actual came in at only 13,415, so you had a positive variance there of 6,585. And just noting that the prior year was actually 23,207 and just had quite a few more small type repairs and transactions in 2023 than 2024. You did have an increase in insurance premiums for 2024, and so that was over budget by 6,303.
So specifically with that one, because we do know what our premium rate is going to be for when the budget is made, this deficit of C303 in that line item is because at least one person changed what plan they were on, which swings it quite a bit. So if they go from the HSA plan to the non-HSA plan, we're covering 70% of that premium, so we cover that increase, but then also their HSA or EVA contribution on the back end changes as well. So
that's actually your group insurance. This insurance line item is your general insurance.
Oh, that would be up here.
That's which did go up as well. Similar numbers actually, but that stuff's done.
Oh yeah, this one. So the premium ones, that's just an educated guess.
Yes, and slash who knows what's going to happen to your work comp. So
yes,
that's kind of a shot in the dark sometimes. Street repairs and maintenance budgeted for 129,000. Actual came at 114,393. So that was under budget by 14,607. It did increase about $11,000 from the prior year, and that mainly because there are some sidewalk repairs that were done in 2024 that were not done in 2023. The improvement other than buildings budgeted for 45,000 and nothing was spent. I believe that budget was for the 28th Street sidewalk, or at least part of it, and that all got paid for out of the capital outlay actually. So there's nothing in this line item here. Snow removal is the next category. Budgeted for 15,000. Actual came in at only 4,230 for a positive variance there of 10,770. I think every single one of my cities around here had less snow removal in 2024, so that's nice. And
shouldn't have said that.
knock on wood. Street lighting is the next section. Overall, it came in under budget by 7,274, mainly stemming from your utility costs were actually under budget this year by 7,595. Next page is the start of the sanitation. Sanitation overall came in under budget by 4,859. It is very similar to the previous year as well. Some of those costs mainly stem from your trash day stuff is very variable. That's the biggest fluctuation with your budget. Culture and recreation is the next section, starting with the swimming pool. Overall, you budgeted for the swimming pool expenditures to be $162,727. Actual came in at $156,016 for a positive variance by 6,711. Within there, your salaries was budgeted for 62,000. Actual came in at 73,757. Part of that stemming from pay increases. Part of that stemming from your staffing. Josh and I discussed even things like your private lessons and such are starting to cost. More and more people are doing that. So even though there's an increase in some revenues with that, the cost behind it is getting a little bit more than the revenues are coming in for it. Operating supplies budgeted for 35,000. Um, so you had a positive variance there by 10,217, but just noting that that cost is very similar to the previous year. Same with utilities, budgeted for 25,000, so you had a positive variance there of 8,623. However, those utility costs were very similar to 2023 as well. If you're looking at a variation from 2023 to 2024, the equipment is one item that there was nothing spent on in 2024, but in 2023 there was 7,383 spent. And last year you guys had purchased 2 new pumps and a leveling system in the pool. I'm not going to cover anything under Boy Scouts, skating rink. Next section then would be park areas. Total park areas was 94,163 budgeted. Actual came in at 89,108, so you have a positive variance there overall of 5,055. 2 big fluctuations would be your salaries came in under budget by 13,383. Very similar to the previous year though. And repairs and maintenance again budgeted 15,500. Actual came in at 26,128. So you had a negative variance there of 10,628. Again, stemming from that capitalization policy. So picnic tables and benches at one point in time were something that used to be down in your equipment line item. Now is up in your repairs and maintenance and supplies. So that's where the majority of that increase stemmed from this year is the purchase of picnic tables and benches. Buildings and improvements. This year you budgeted 10,000, you spent 9841. Just to note there, what you did spend that money on was for the band shelter roof, which actually you guys got a $10,000 grant to offset this cost. So actually you made money on the grant, if you want to call it like that. And then the previous year, just to note that that was the electrical work at Guller Park. Equipment, that's where I was saying that line item was supplies. So the previous year equipment has $6,380, and that previous year you had picnic tables and waste disposal systems. So that's just particularly where line items fell between 23 and 24 with changing that capitalization policy. I'm not going to cover anything in culture areas. Cable.
The band shell grant, we were even Steven. This is all of the that Trevor did with the roof, but then we were able to buy a few gallons of like stain for the floorboards that wouldn't be in this line item, it would be in operating. So we went to the 10,000.
There's nothing budgeted in your PEG section. Just wanted to point that out. However, both years, 23 and 24's was 13% up. Jackie's allocated, so her health insurance, her wages, etc. So that's where it stems from.
We didn't budget for that.
That's what she like talked about with me before.
It was that
the budget was way changes
Yeah.
fund accounting system.
So she was budgeted in 2023 for that, but 2024.
The scenario was flipped for, if that makes sense, for Jackie and I.
Airport, all very similar to budget, except like I said, that improvement other than buildings, you budgeted for the 436,000 you expected to be able to spend on the hangar rehab since the state didn't approve giving you those funds. You did not spend that, so actual there only came in at 3,802.
So just to pause there, and we went over this with Myra and the state about a year or two ago. It used to be that you would do in October, you do your capital improvement plan through the state for like the next 5 years, and you were pretty much guaranteed that whatever was on your next fiscal year, because their year runs July to June, that you were pretty much guaranteed that money. Well, then the legislature stopped funding the airport fund as much, and so then they started ranking them in terms of importance by region. So we are the Southwest region, so if you don't score in their formula over 80 or whatever, then you don't get picked because they're prioritizing their money. So we didn't score high enough for our hangar rehab, but like last week we just got the email that said our airport layout plan grant for fiscal year 25 was approved. So now we got $50,000 for that or whatever. So you're kind of at the mercy of you were always at the mercy of the state on the money that they gave you, but now you're even more at the mercy of the state because they can say, well, this project at this airport was more important than yours, so we're giving them money instead of you, basically. And we don't find that out until our calendar year budget is done. So that's why that's not the first time that's happened. We have X amount of hundreds of thousands of dollars budgeted, neither the expense nor the revenue. It turns out to be that.
Okay, nothing else under airport, miscellaneous. Miscellaneous is budgeted for 35,862. Actual miscellaneous came in at 109,624 for a negative variance, and your miscellaneous 73,762. Biggest things in here: unallocated electrical analysis budgeted for 5,000. Actual came in at 81,722. So this is where you guys are accumulating all of your costs related to the Excel transition to the city. Ideally, when and if this all goes through with everything, you will transfer money from, or you will recoup funds for this in your electrical charges and recoup the general fund and transferring these funds back eventually. So what's in there for the 81,000 is majority of it's professional fees, all of your meetings, your special meeting, your special elections, and feasibility studies and all that such. That's all in here from last year and this year. Unallocated general insurance, you budgeted 6,362, actual is 0. So now virtually all of your insurance is being allocated in one way or the other, whether it's getting, some, I don't even know what was really going on unallocated at one point in time.
There was a bunch of stuff going in there, and specifically the 6362, I believe, was the SRDC premium, which they pay.
They
but it was
reimburse,
just
yeah.
put it in a GL because it might get lost anywhere else. But yeah, now they all have their own specific GL codes.
Yeah, I'm not sure what made up the 2,236 at one point in time, but it could have been very much just
It was
like an unallocated
Christmas
fee or
house
something.
and-
Yeah.
Because actually, this is identical vein of conversation as we discussed with these technology fees, like just getting the correct GLs for these consistent expenses and revenues for that matter. That we could just create those GLs so now we have some place to put stuff. That's correct.
I always heard that accounts look like miscellaneous.
We do not like miscellaneous. Unallocated is not okay. No. That's why I think you guys have a spreadsheet now for insurance that's pretty much like, so it's consistent. This vehicle is at this one at this account, so it's very, very consistent now that you guys are using those spreadsheets. Unallocated natural gas utility is the exact same concept as the electrical analysis in the aspect of we're going to build all of your costs in this line item that related to the natural gas utility. Ideally, if and when this goes through, again, build a fund for the natural gas charges for services with that and recoup it to the general fund one day.
So you had said we're tracking all the charges within those specific line items, Katie. Do you mean that this is a multi-year accrual or
No.
that is
That's this year's cost.
That's what I thought.
But in the aspect of when we are able to create an electric fund, or you guys create an electric fund, we will take, because there's costs back to 2022 as well.
Yeah.
So we'll take 22, 23, and 24, add them all up, and you'll transfer that money back.
Just want to make sure.
So yeah, you're over 100,000 now into it.
Yeah, those 2 years alone, it's 81.
Yeah.
Whatever plus 14.
Yeah.
And I'm assuming 2025 is probably going to be just as bigger than 24 because of everything else PUC process.
The lawyer bills are they have jumped quite a bit in terms of the amount that they are. So
yes. Like I said, we just had a $12,000 one.
Yes.
This month.
They used to be 2 or 3 at a crack, and now
like I said, with the whole PUC
offering
process
testimony
over the next 12 months, it's going to get significantly higher.
Yes, we are.
Because it's all about them at this point.
And it may take a little bit to recoup. I mean, because once you're getting that fund going and stuff, you're not just going to instantaneously be able to transfer over $100,000.
Track there.
Yeah.
No, but it'll be included because we passed the resolution.
Or due to that time.
We passed the reimbursement resolutions for the bond. We're able to include that
in that original.
Yeah.
Essentially, we could
do it right away.
Yes, we can do it
ourselves.
Yeah.
Okay.
And then just finance it over the life of the bond.
Well, that's actually 2 different funds. Then that will be a bond fund, and then you'll have your electric fund, and you'll transfer funds from the bond fund to cover that, but yeah,
Yes.
that's future conversation. Anyways, total expenditures then was budgeted for 2,635,522. Actual came in at 2,169,678. So you had a positive with your variance there of 465,844. Again, just like your revenue is mainly stemming from your biggest variance there being your import stuff. That leaves in excess of revenues over expenditures as of right now 421,819. You have other financing sources and uses coming in, so there's nothing budgeted from proceeds and sale of capital assets. However, you sold your 2014 police inceptor, and that had a gain on sale of 6,429. You had proceeds from insurance recovery, nothing budgeted for, but actual came at 3,400. So actually, there was the PW truck that was repaired in 2023, and then the insurance proceeds on that didn't come in until December of 2024. So we would have never seen that way after audit's done. So that's why that's just a random line item in your stuff. And your transfer from your broadband construction fund, nothing budgeted. However, there's a transfer of 6,295. When we get to your broadband fund, you'll see that the state or the feds reimburse actually for Josh's administration time in here. So to close out that grant, we transferred that reimbursement for Josh's wages back to the general fund then to cover Josh's wages since that's where they're originally paid out of. Previous year's transfer in from the broadband construction fund of 16,112 was prior to the grant getting started. You guys had costs behind the grant as well, which then when we got the grant funds, that money reimbursed those costs, so you were able to transfer the money back into here in 2023 on those original costs before the grant got started. Everything else was your transferred to and froms between your different funds, and those all went through as budgeted. So overall, you have a net change in fund balance at the moment of $138,760. Like I said, when we kind of started in the general fund, you have the ability to transfer $126,135 over to the capital outlay. So essentially, if you guys approve that transfer, your net change in fund balance will be a little over $12,000.
So at the conclusion of the general fund, do you want to do that? Consider that motion now, or do you want to wait till the very
I think the only other question that a few years ago when we were these houses and what got to this point, and there was so much that we were just gonna put to the capital improvement to cover. Well, no, but we actually split. Like we took
Oh yeah.
like 20,000 less or something, put it into the EDA so it would have money. But we have another house to tear down. Yeah. Does that have to go through the EDA? Or fine, just do it the way we're doing, or why do we do it that way then?
So,
I know specifically it was a one-time thing, and we tore like 3 houses down,
yeah.
and we
That was last year. And there was no it was about 30,000 in blighted property, 28th Street.
Am I thinking of something different?
I think you're kind of combining two different distinctions.
I think at one point in time there was a couple transfers that occurred because you were closing out some bond funds, and your bond funds can get allocated to different things. This one can too. You guys can do whatever you want with it. Really, it sits in capital outlay mainly for the fact that you're building money in your capital outlay too.
Yeah,
Do you mean specifically the 10? Because the 10 increased a few years ago. It was like 5 or 8 or something.
well, we increased it, but I remember one year, maybe it was 4 years ago, but we got to this point. We were talking about all this, and we had some EDA stuff that we thought we needed to pay for. So instead of putting the full amount in the capital improvement, we took 10 or 20 and put it in EDA, and the rest of the capital. Nobody else remembers that. Maybe.
I kind of remember.
Yeah.
What you can also do is just do it to capital outlay for this year. And then when you guys decide like, hey, we are gonna do that blighted property this year out of the EDA, we want to allocate some funds to the EDA, you can transfer it from your capital outlay over to the EDA to cover it at that point when you guys know the dollar amounts and such. It's another option. It doesn't need to be done at this point.
So another thing that's kind of changed, within the last year is that we have all of the equipment to do at least a property that size ourselves. So, like when Weston gets back from vacation, like next week, he intends to start tackling that house. The only cost into it will be the roll-offs.
Yeah,
Carving
and the city paid for the land acquisition itself, but I guess it did have the intent of running the demolition of it through the EDA because that's always been kind of their
yeah.
side of things, that blight, removal. So, but that won't be nearly as much as previous years because we're not paying a contractor to tear the actual house down.
You can wait till we get all the way through if you guys want to see where the other funds are sitting. It's totally up to you.
Let's just forge on.
Okay, we'll cover that last. All right, the big fund's done. Library fund starts on page 63. Overall, similar to the prior year, you have assets, liabilities, and fund balance. Overall, your assets and fund balance, liabilities and fund balance is 11,541, down a little bit from the previous year's 11,644. And if you switch to the next page, stems from well, you actually have a current year profit, but some of it's locked up in accounts or prepaid expenses. Anyways, the library fund P&L starts on page 64. Overall, your total revenues were budgeted for $41,515. Actual came in at $42,085. So you had a positive variance there of $570. Overall, similar to the previous year and as budgeted. The previous year's miscellaneous revenues actually is up a little bit compared to this year because you had a refund from the state of Minnesota for some unemployment that you had paid in COVID years. But overall, very similar to budget. Library administration, starting with the budget was $180,008. Actual was $181,424. So just a slight negative variance with your budget there of $1,416. But there are some large fluctuations within the categories. So salaries was budgeted $97,390. Actual came in at $78,066. Overall, though, that salaries is similar to 2023. The group insurance was budgeted for $28,703. Actual came in at $19,981 for a positive variance there of $8,722. I did want to point out, though, it is up significantly from 2023, and that's with the new employee. They are on the family insurance plan versus the previous employee there was on the single plan, so the costs behind that for the city is a little bit more. That being said, Josh said that the salary was decreased for her, knowing that she's on the family plan, so that's why your salaries is probably under budget there. Repairs and maintenance was budgeted for $6,250. Actual came in at $15,350, so a negative variance there of $9,100. In that category, specifically, when you own a building or own an asset and you do demolition work to get, like in this instance, the new carpet in there, the removal costs get put as an expense in repairs and maintenance. If you purchased like the library and then redid the carpet immediately, you would capitalize those demolition costs as a part of the new asset. But because it was your guys' building existing, the floor removal costs of a little over $10,000, I believe it was, is in this repairs and maintenance category. But then when you go down to the buildings and improvements line item where there's nothing budgeted for, there's $21,036 spent. The library carpet is in that cost. So actually the overall cost was like between the library carpet and LED lighting was like $31,000, but the $10,000 part of the floor demolitions in the repairs and maintenance category. Overall, then your library reference is similar to the previous year, $11,949. So you had a positive variance there by $1,551 as well. So overall, your total expenditures were budgeted for $193,508. Actual came in at $193,373. Which left you with a deficiency of revenues over expenditures of $151,288. With that, you guys anticipated that with your budget, so you budgeted to transfer in $151,993, and you transferred those funds in as budgeted. So overall, actually, there was a net change in fund balance here of a positive $723. So you guys accomplished your goal of dwindling your fund balance here. It's at where it is, and then you hit it right on the spot to maintain that fund balance for 2024. The next fund is the fire equipment fund on the top of page 65. Total assets in the fire equipment fund this year dropped to $48,260 from the prior year's $191,583. Biggest thing in there, you can see your cash and checking went from $186,533 down to $36,315. which that decrease stems from the current year fund loss in here, which will come when we get to the next page. The other line item in here I wanted to cover was the due from other governmental units of $4,770. So each year you guys are sending out contracts to the local townships, and Lime Lake Township missed paying their contract in 2024, and it wasn't really caught until we had done your audit and brought it to Josh's attention that that was missed. So he did approach Lime Lake, and they are addressing it to be paid here in August too, guys.
Next
Um,
week.
Next week. Accounts payable decreased to 0 this year from the previous year's 4,830. That's just the timing when bills are being paid, but the previous year's accounts payable had an 18-inch super fan in the accounts payable. And then so your committed fund balance actually decreased to 48,260, which stems from the current year loss, which starts on page 66, the income statement for the fire equipment fund. Overall total revenues were budgeted 51,258. Actual came in at 74,195. So you had a positive variance with your budget of 22,937. The state grants and aids, there's nothing budgeted for. However, you received $1,100. That was a DNR grant for some equipment and supplies. The previous year had an $8,000 grant from the state for your gear washer. Overall, your charges for services budgeted for 36,000. Actual came in at 35,000. So overall, similar to budget in the prior year. So I'm not going to cover anything there. Your miscellaneous section, other grants, you had nothing budgeted for. However, you got $4,000 from Nobles Co-op Electric grant for equipment and supplies, and then contributions and donations that fluctuates pretty significantly each year. Most of your donations stem from the Relief Association itself to help pay for equipment and such. Budgeted 15,000, actual came in at 30,815. So you had a positive variance there of 18,815. Public safety in your expenditures, overall just budgeted 11,400 for equipment. Again, because of that capitalization policy changing this year, your radios, flashlights, shields, and all of that stuff fell underneath that capitalization policy. So that's now in supplies this year of 2,368. You had to pay for some professional services that was unbudgeted for $1,400 for some assistance in the grant writing for the pumper truck. The miscellaneous category, there's nothing budgeted for. However, both years you had spent $7,500, and that's for your fireworks. And then the Relief Association in their donations does reimburse for those fireworks. This past year, it wasn't fully reimbursed per your guys' agreement, but in 2023, the Fire Relief Association did reimburse the entire $7,500.
Can you get some money from Excel Energy too?
That goes right to the relief.
Oh, that goes.
Yeah.
So the Relief Association, that's when that stuff comes, the Relief Association gets it, and then you guys remit it back to here to cover that stuff.
Well, I don't. Yeah. So then the 1 year was probably not fully. I got it. Okay.
The equipment, you budgeted 11,400, then actual came at 37,840 for a negative variance there of 26,440. You had purchased a Ranger, chargers, and radios, a Telecrib squat kit. So that's items in this year's expenditures. Debt service, that's actually where a majority of the fund loss stems from. So you budgeted 39,752, which was your required lease payment. The lease actually wasn't due until 2028. However, you guys paid the entire lease off to First National for $198,763. So you had a negative variance there of $159,011. And like Josh and I had discussed about it, it's mainly stemming from the fact that you guys are trying to acquire a grant, I believe you said, from the USDA to get a new fire pumper truck, and in order to do that, you had to make it look like the funds weren't there to pay for it. So paying off this lease, make your one lease or your one piece of equipment fully paid for, and now the ability to hopefully get this grant going forward for the new piece of equipment. So that is why you guys paid that off early. So overall, there's a deficiency of revenues over expenditures of 173,676. Other financing sources that came in, you did sell your 2008 Polaris Ranger when you purchased the new one for $2,500, so you got money from that. And then, as scheduled, you had transferred money from your capital improvement fund for $32,683, which then in turn left your net change in fund balance at $138,493 loss. And then the next page is your small cities grant fund. Checking and fund balance are both at 24,104. Previous year's 24,150, so a small decrease in overall your checking and committed fund balance. So the next page is the income statement for that. This is your small cities development grant fund. This is all federal funding, so this is a part of your single audit, and this is the category of your major program. Both the broadband grant and your small cities development grant have the assisted listing number as 14,228. So this gets netted with your major fund for your single audit. So virtually everything I looked at in this fund. So he had $324,864 in federal grants come in, and then in turn $324,910 go out. So this is a reimbursable grant. So you guys spend the money and then the reimbursement. So when we said that DSI had that scarcely bill paid late, or you guys had that bill paid late to scarcely, is because you guys are waiting for these funds to come in and then you cut the cost back out. There is a $46 net change in fund balance negative here in 2024, and which would be a non-covered cost, which would be a county title transfer fee. That is not being covered by the grant, so you are using existing funds to cover some of those title transfers. You'll see last year too, there was some small office supply stuff. I believe it was like checks. And then miscellaneous of $46 again, and then a $20,000 local commitment on your small cities development grant. So last year actually had a loss as well of $20,088. So not everything is getting 100% covered by the grant, but a majority of everything going through here is.
So is this the account that people pay the loan?
Yes.
Goes into. That's
Of which there are three of those that started in July and August of 2025.
Oh, your people loans. That you're talking about your EPA loan. I was like, no, but
people, the small
the
cities.
small
right?
cities. So yeah, there is actually no loan advances yet as of the end of 2024. You guys started that in 2025, or
Correct.
Eventually that will be.
Well, technically,
so eventually I'll
Well, yeah, they're all
advances.
they're all.
Givable.
forgivable loans.
There's just
But
nothing
there's-
coming back yet.
There is three
Right.
of
So when
them.
that money comes back in, it's used for future purposes. It's supposed to like refund itself
Yeah.
over and over. Unless you guys forgive these ones.
It's up to our property owner sells their property.
Yeah. Term is up.
Yeah.
And I'm assuming you have those all at the county and they're keeping track of that for you, I'm assuming. So
The repayable ones.
yeah, like the deferred part that if the house is paid.
Because if they
Well, they're all
sell,
part of the recorded mortgage.
Yeah.
So it wouldn't be a special assessment. So it'll show
It'll show
up
up
as
if they
an
sell it,
encumbrance
yeah.
under search or whatever.
Yep. Next page is your EDA. Your EDA overall assets and fund balance is $50,461, up from the previous year's $40,494. The next page then is the P&L for the EDA. So there is a small $3 electrical rebate credit coming in 2024 for some of those utility costs here. That there was $36 in utility costs allocated to the EDA. Biggest thing here is mainly actually in last year's, like I said, you had spent money on the blighted property. So you had demo and seeding of 2307 Oak, 2459 King, and 2035 28th Street for $29,374 last year. So overall, this year there's not a whole lot of activity in your EDA except the fact that you did your transfer from your general fund as budgeted of $10,000, which actually left the net change in fund balance as a positive $9,967 then for 2024.
See, that's why I got confused with, because you just said last year again, and what actually I think it's 2 years ago.
Last year in the eyes of the financial statements in front of you. Yeah.
That was the disconnect.
Three.
Right there. Good.
Live in a whole different year than everyone else.
we're all in 2020.
Yeah, you guys are all in 2025 and I'm still in 2024. The next one is your EDA's revolving loan fund. So, you guys have loan payments or loans out with Cool Ball and Second Wind still. So overall, between those notes receivable and your cash and checking, there's a total assets of 230,604, which is very similar to the prior year's 22,000 or 229,639. Essentially, see they're paying their loans off, and the checking account is increasing based off of how much their loans decreased. There was an accounts payable of $77 last year. It is still hanging out there this year. I did tell Josh that was actually because Fixed and Chiropractic overpaid their final loan payment to you guys. We noted that at the end of 2023. I think it just kind of got bypassed because it's such a small dollar amount. So Josh has now since then cut that payment back to them to repay them for their overpayment from 2023
Are these principal balances or the amount of money received?
on page 71
Yeah,
or page
that
7.
11,400.
That's all principal balance left.
That's principal balance left.
Yes. And then you can see the deferred inflows of resources are the exact same dollar amounts because we don't recognize any of that as revenue until they actually make those loan payments. So it's just the loan payment, or that's the balances of the principal hanging out there. So it leaves a committed fund balance of 217,634, which that increase stems from the current year profit. So if you flip to page 72, then you can see that in 2024, overall note payments was $9,984 received. Biggest fluctuation from 2023, like I said, is Fixed and Cairo paid their note in full, and so they paid $13,066 in 2023. That is no longer in 2024. These loan payments here include both principal and interest. Expenditures for 2024, there was none. Previous year, you guys did spend $3,500 as a local portion of the facade improvement program for 507 Designs building being redone on the front. So overall for 2024, the actual net change in fund balance was $9,984 in this fund, which is just the notes being repaid.
Where's the interest get booked to?
It all gets booked in the same line item here. So overall, that's what they did pay. Principal and interest was $4,400 for Kubal, and second one was $5,584. It's weird because unlike private financials where you would segregate principal and interest, you don't do that in governmental accounting. So it does in the front page, not the back pages that you guys are seeing right now.
Which is odd because not only is it different from private, but it's also different from what the state asks for in all of their
Reporting.
where they do segregate it out.
So what you guys see here is the back pages of your report because it's in a lot of details. What the state sees in the front is actually, which is your modified accrual basis, actually does break out interest and principal. That's what the state. That's what the state looks at.
No, that's like the narrative version of.
Oh, so that's not something we know. Okay.
You guys will see it in the full packets when they're done. And it does break down principal and interest in all of every single one of the front pages. Yeah. These actually are non-required pages to go to the state. We just give them to you guys so you guys have them because it's a lot more detailed. The front is like, here's your EDA and it's one lump sum number. So it doesn't do you any good for me to come in and go, here's one lump sum number, here's what makes it up. So this is all the pages that make up your front numbers that the state actually looks at.
It's hard to make decisions on what to do with
Yeah.
money if you don't know
lump
what's
sum
going on.
Yeah, lump sum stuff. That's why we present these to you guys because this is like what makes sense. The front page stuff is all summarized synopsis, and it's literally summarized in 4 pages versus 50. So anyways, that's that. Your GO bond series 2018 A fund is your next one on page 73. Total assets for 2024 are $394,770, down from the prior year's $422,105. Biggest thing is your cash and checking decreased to $341,271 in here, which is a reflection of the current year loss. This fund does owe money, I believe, $120,000 to the water fund and $120,000 to the general fund, if I'm correct. So eventually, hopefully, one day capital improvement. So hopefully one day that will be able to be repaid to the other funds. So overall, there is a restricted fund balance in this of $154,770, and again, that decrease stems from the loss, which on the next page you'll see. Overall, your revenues in your 2018 fund, you guys are budgeting for some property taxes or some of your levies that's coming into here, $29,400. You actually collected that $29,540. And then you have some interest revenue stemming from your money in your CDs and savings for your 2018 A fund. So actual revenues were $30,061
Where's lot sales get booked?
at the bottom.
Yeah.
Other financing sources
Oh,
uses.
got it.
Other
Yep.
sources.
They don't, so lot sales and transfers and all that stuff, that gets put as financing sources and uses. Your expenditures in here, you budgeted 87,266, which is just your bond payments and your agent fees. Your actual came in at 87,291. So overall, that leaves a deficiency of revenues over expenditures of 57,230. And then what you guys are doing right now is because there has been no lot sales the last 2 years, you guys are transferring money over from the water fund to assist in covering your bond payment, essentially.
That's not why we're
No.
doing it. That's been budgeted like it just didn't happen in 2023 apparently for some reason. But a portion of that bond is utility costs. So
Which we discussed then too about, which we'll cover when here is the water fund, but including like line items that are specifically in your utility bills going forward, saying this part of your utility bill is to cover infrastructure improvements or whatever, bond payments, or every city does things different, but overall then, because there was no lot sales, the net change in fund balance actually is a negative 27,335 in this fund.
We have a lot sale in 2025.
sure do. Flat fee for Stacy, yeah, so it's actually not that much that gets taken out of there.
So we're covered already.
Yes, there.
And they're
This,
actually
as in this year. We're
25.
they're
Yeah,
actually-
yours is next year.
in the calendar year of 2025, they're actually maybe
Yeah.
Ideally, that's what's supposed to be covering those bond payments eventually.
strong interest. We'll call it one. So one's pretty certain.
Yeah.
Good to hear.
I'm running upward. Page 75 is your lease revenue bond 2006, series 2006 fund. This is
Did you talk about the transfer from TIF, or did I miss that?
Am I on the wrong page? What page are you on? I'm on page
75.
75.
Wow. Yeah, I have a note about transfer.
Oh! I'm sorry. No, I did not cover that. So, you guys are collecting TIF revenues and TIF 5 as well. Right now, when we get there, TIF 5 has about 62,000 in your fund balance at the end of 2024. Per your TIF reporting, they are suggesting to transfer those TIF funds over to the 2018 A bond to cover future bond payments as well. So you have lot sales and TIF money from the TIF 5 to transfer in here to cover future bond
Also,
payments.
so far,
So actually, you're collecting two different types of things. You're collecting property taxes for 29,000 for the 2018 bond, and actually everyone who lives in the TIF district is also paying TIF taxes or whatever you want to tax capture. So there's money coming in on two sides on this. The reason the TIF money isn't coming in here is because you have to have a TIF fund. So the TIF revenues are getting reported in the TIF. There's not any actual expenditures really going out of there, so you're allowed to transfer that over to cover your bond payment.
so thus far we haven't taken any TIF money from that, because that is the fund that's allocated for that.
I don't believe you've done any transfers yet.
No, and there really wasn't any rhyme or reason for why Ayler's up to this point didn't recommend transfer.
That's right.
It's got a healthy enough fund balance for them, I guess, to be like, well, yeah, you're consistently getting tens of thousands of dollars a year now, I guess. So you can. Our intent is now to zero that TIF fund out at the end of every year.
So right now, there's a fund, you'll see it
Prior
right
to
there.
the audit, so it's not an audit.
So in
entry,
2020,
it's just
2025, there's like 62,000 left for 2024's fund balance, which Josh has already transferred that over here to 2018 A. And then when we get to doing your audit, once we get the final numbers in TIF 5, we will do a suggested transfer, just like we do here on your capital outlay to your general fund, your capital outlay going forward. There'll be a recommended transfer from your TIF 5 over to this bond to cover on.
So in reality, instead of a deficiency of $49,000, we have excess of roughly 12.
Well, that was your variance. You had a deficiency of 27, but
Oh,
yeah,
27. Sorry, variance. Oh,
So-
that's even better.
Yes, it is.
Okay.
Yeah.
Which
eventually
then
between
begs the question of when do we want to repay it? So
due to new funds, yeah. Because essentially, ideally, what's happening here is your property taxes, your TIF money, and your lot sales should be covering your bond payment, and hopefully you can repay those other funds here eventually. But
So you said there's money that is owed from this to the general fund.
not
capital outlay,
120
capital outlay,
120 to water and 120 to capital.
Oh,
so essentially those funds initially covered
We can do
to cover the
pay
fund.
them both off. I don't necessarily think I'd recommend that. As conservative on that, like half to each or one and not the other, whatever.
well, I think yes. Oh, don't anything to see if we get through this hump wall.
Yeah.
One lot sale.
I say get some lot
Let's
sales.
just chill. I would say.
Joe, I agree with that.
Chilling is okay with me.
Conservative.
It's all sitting in the same checking account essentially, so it's not like one's earning interest and one's not or whatever. It's just sitting there. It's fine. Just know that one day when this closes, something's got to be done. Page 75 is the lease revenue bond series 2006, which is your RDC bond loan, whatever you want to call it. Total assets this year 134,590. Previous year 184,558. Biggest thing in here is your finance lease receivable is getting paid as scheduled from the RDC, so that receivable now is down to 81,000. 2025 there will be another good chunk, and then the final payment in 2026 on that finance lease from the RDC. Again, the deferred inflows of resources is the same exact dollar amount that decreased because it doesn't offset of the lease until the lease payment is made. So overall, this fund is sitting with an unassigned fund balance of a negative 16,985. So essentially, if this was the end of the lease, that's what the RDC is going to owe back to the city at that point. They are paying their lease above and beyond what they need to now, I believe is what Josh told me.
Correct.
So they're trying to get this caught up so that they don't have one big balloon payment to you guys. So
We also have
There's
the
also this
$50,000.
$50,000 security deposit,
Yeah.
which is their money, and they know that if this is still a negative fund balance, that this will be used at the termination of the lease when we transfer it fully over to them. Will be netted out.
So essentially, you still have their money to cover this.
So that 16 or that 17,000 is what they owe us, even if we don't give them that money back. I mean, like right now, that's
Right.
owed without giving them that back.
The second one.
Right. So you still are net if you want to net. You still owe them 33,000 essentially if you want to think of it like that.
Yes.
But it's not really owed that money. You guys have to
What's happened with the structured payments with the lease is that some of the costs and whatnot have shifted the 20-year period, and so
It used to be your interest. So when interest rates were really good, they made decreased lease payments to you guys in the idea that they were earning interest on it, and then they reduced their lease payment, and so eventually at one point in time the interest being earned on this was very little. CDs went down to less than 1%, and so then they were decreasing their loan payments to you guys too much, and that's how this deficit grew. It was many a years like that. Which when you do each year and you go, oh, it's a couple of $1,000 or it's a couple $100, you don't think much of it until it adds up years later.
They're in arrears for 17 grand.
Yeah.
exactly.
And if they don't catch it up,
Which
Yes, but
$50,000
this
damage.
may sound stupid. It's a planned arrears there. I mean, they have no one.
Yeah.
as their staff has turned over, it's been a new discussion every time. So yeah, they know that they're not going to get the full 50,000, and they're perfectly fine with it if
And,
they don't.
and the board was well aware of this situation a decade ago. But there was a point when when the interest rates were getting so low, they had a cash position. They thought about just paying it off. But because when we refinanced back in whenever it was, everything's so convolutedly mixed together, Hillers couldn't figure out how to untwine it from what I understood back at that time.
That's correct. That was back when Steve was still. Yes, that was one of my very first things that I worked on was an attempt at some forensic accounting of what's due in tax exempt bond versus non-tax exempt bond between 2006A and 2006B.
And there had been a bond defeasance that was done in there too for compliance.
Probably had
reasons.
4 or 5 CPAs looking at it all at one time, and nobody could figure out. So they just said, well, because the interest was to pay it off.
Yeah, because they're looking at they weren't getting much for their investment, so I thought, why don't we just pay it off?
Yeah. So then 76 is the income statement for this. So essentially, like I said, your interest revenue and then your finance lease money coming in is enough this year to cover your bond payment, which was $60,044 the last 2 years. So this year there actually is a positive net change in fund balance of $335. And like I have a note on there, you have a deficit fund balance. Like I said, we've already covered that. It can be covered by the RDC, or that's your guys' intentions. It also could have been covered by your TIF 2 excess funds, which you guys have now committed to the Wonder Roll project. So the RDC essentially is covering this, and we don't even talk about it any further. So, your general obligation improvement bond series 2024A. This is a new fund. This is your bond for your Maple Avenue project, essentially, but we have the formal title on top. So your cash and checking is 51,913, and deferred special assessments receivable is 61,714, which makes up your total assets of 113,627. Your deferred special assessments receivable essentially is all of the unpaid Maple Avenue residents who did not want to pay in advance. You guys did a 10-year installment on this receivable with a 6% interest rate. So essentially you guys are going to get a little over $6,000 a year plus interest from these properties, and or they can come in and still pay in advance each year if they want to. But that's what's sitting at the county level.
How did that turn out as far as what they anticipated?
We had budgeted, so that's I think more so.
You'll see that when you hit to the next
So I think
page.
35 is what we had estimated, and we took in 42 41s.
So
we were thinking 35. They were estimating 35 in cash up front. And they took more.
Or we took in more.
A little bit
So
more.
that means we get less interest over time.
Correct.
Essentially, yeah. But you can invest in an interest bearing account and earn interest that way at not quite 6% probably right now, but anyways, totally off that. Page 78 is the P&L for this. Essentially, there is no budget, was no budget created for this. I believe it was all actually in the Maple Avenue fund, but this is your bond fund. So your special assessments actually came into this fund. You have no expenditures going out of this because there was no bond payment due in 2024. So this is where your bond's going to get paid out of going forward. And then you had other financing sources of 11,672. So essentially your bond was in excess of the actual cost of Maple Avenue because of those excess prepayments and etc. So you're able to transfer in 11,672 to cover future bond payments essentially. So this has a fund balance starting out at 51,913 to cover 2025's bond payment. Page 79 is your capital improvement fund. Overall for 2024, the assets were $1,024,098, down from the prior year's $1,199,645. Like I said, at your general fund, there's less money sitting in these CDs, so there is less in an interest earning account. However, your checking and savings, there was still a decrease overall, which stems from the current year loss in your capital improvement fund pre-general fund transfer. So I'm going to say that. So again, there's no interest receivable at the end of the year because there's no CD at the end of the year. Biggest thing to point out, and I guess in your assets here, is your deferred special assessments receivable balance at the end of 2024 was $30,467. You guys are assessing, I believe it was for Juniper Avenue. Yeah, Juniper Avenue has a 10-year special assessment as well. That is done in 2025. So there's about 8,000, I believe, getting assessed each year on that. The remaining portion is like 22,000 is made up of deferred special assessments that aren't paid until lots are sold. Particularly properties that I don't know if they'll ever be sold.
North Tamarack.
So
Yeah.
North Tamarack, right?
I don't think that's all of them though. There's a few in there like Kurtzma and
Oh yeah.
there's little ones all over the place from projects throughout many years. So
80s, 90s.
yeah,
Yeah.
we really tracked those down last year. We found them all. We found every single penny of them. So
Katie check.
they're everywhere. But yeah, there's probably 5 different projects that stemming from 80s, 90s, early 2000s that there's deferred special assessments that, like I said, you guys aren't going to collect on them until those lots are sold and or these owners.
The city was a large fan of deferred special assessments in its yesteryears. We don't.
Yeah.
I'm not.
Well, and I think
Unless
it's
they're
fine.
statutorily mandated.
The terms weren't very because a lot of them hinged on sale.
Sale property,
So like if the developer decided to build a house on their own property, their assessment remains deferred.
Yeah. I think a lot of that Tamarack one's actually in the water fund. When I think of it, these are other ones.
Yeah.
So, anyways, above and beyond that, they're gonna have about another 8,000 come off here, and then the rest of it's gonna kind of hang out there until people sell their houses. Your accounts payable decreased to 2,589 from previous year's 15,789. Again, that's just kind of a timing of when things are purchased and when bills are paid. The prior year had 3 PD radios in there that cost of 15,000. The current year's 2,589 is related to some trickling in 28th Street sidewalk costs that weren't paid until January 2025. Overall, that leaves a committed fund balance this year of 991,852, which is stemming from the current year loss before the suggested transfer from the general fund. Page 80 is the start of the income statement for your capital improvement fund. So overall, you said capital improvement fund budget to actual, I just in every city, I don't even really like to call the budget aspect of it because this is kind of the catch-all fund, but overall, your intergovernmental revenues was 241,256. That is federal aid stemming from the flow through from the county for your 28th Street sidewalk. So essentially, when you guys budgeted this, you budgeted it as a net cost, but because this is a federal grant, they have to show up on your schedule of federal expenditures and awards. So we have to segregate that grant from the county. So the revenue shows up in here. Miscellaneous, you had 6,537 coming from interest revenue. Did want to point out that it is down from the previous year because there is less money in those interest bearing accounts in 2024. And then, like I said, you're collecting special assessments as scheduled. This year's was $8,755. Next year is going to be slightly less, and then it will fall off in 2026. Overall expenditures out of here in your general government, you had purchased $5,263 of various office furniture, and because it was underneath the capitalization policy, it got put as a supply line item and not equipment. The previous year's was $17,820, and that was for your pretty hefty cost to civic software update, which also was split between, I believe, the water fund and here. Public safety was budgeted for $27,050. Actual spent out of here was $38,727. You spent $7,073 on squad cameras and computers that were underneath the capitalization policy. That's under supplies. You have improvements other than buildings for $10,750, which was half the impound lot and fencing. You had equipment of $20,904, which was tasers and body cameras, which were above your $2,500 capitalization policy. Public Works, you had overall budgeted 192,000 for, actual came in at 344,462. Biggest cost in here is your street improvements of 342,283, which is the 28th Street sidewalk. So essentially, if you net that up with the grant you received, that project cost you the city a little over 100,000 for the 28th Street sidewalk. Streets and machinery and equipment was $1,857, which was half the Bobcat snow blower, and then there was small repairs or small supplies in here of $322. Culture and recreation overall was budgeted for 266,000. Actual came in at 138,522. So you had a positive variance there of 127,478. Big things, your parks equipment, you spent 41,961 on a mower, your Gullard Park playground equipment, and some landscaping around town. Pool improvements other than buildings, you spent $83,250 to sandblast and paint the pool. And pool equipment, you spent $12,565 on the pool pump and vacuum. So overall, there was a deficiency of revenues over expenditures of $270,396. You had budgeted to transfer in $149,690. From the general fund, there was a little goof up. We actually did budget the $149,000 that you transferred. That was the general fund said 149. Your budget for your capital improvements at 142. So there is a discretion from your budget and your capital improvement, but overall you did budget the 149,690. And then you transferred 32,683 as budgeted to the fire fund. So right now this has a net change in fund balance of a deficit 153,389. Again, we're suggesting to transfer 126,135. So there still will be a slight negative in your capital improvement if you approve to transfer all of the funds over from the general fund.
My family's waiting for me and going.
Speak fast.
Almost done.
Well, the next funds are really quick besides the water.
I'm sure I could just leave it too.
You go right ahead.
Well, you could tune into YouTube, or you could
We have to do the.
you could skip to the water fund, which is the meat and potatoes.
Yeah, the rest of it is all just your.
If he needs to bug out, then he can.
Okay, we'll skip you on to the water fund, which is page 91 at the top. Water fund assets, current assets are 518,872 prior 962,103. Your cash and checking did decrease overall, which reflects the current year loss in your water fund, and also your assets you purchased in your water fund. You purchase everything with cash. Special assessments receivable current is 3,048. Just want to note that you guys did approve people with delinquent accounts to be put on special assessments for 2025. So overall, that's what the balance at the county level is. That's going to be assessed as 3,648. Some people you guys put on assessments did come in and pay their bill ahead of time, so it is less than what you sent to the county. Improvements other than buildings increased this year to 5,193,973. That stems from your Pine Avenue and Maple. I'm trying to speak so fast I can't talk. Pine Avenue and Maple Avenue water projects, or essentially the street projects were being done. Stuff was being done underneath it related to your water, sewer line, or water lines. And then your machinery and equipment increased to 1,671,363. And in 2024, you guys purchased a jetter truck. You did sell your existing jetter that was on a trailer, and then you also purchased a 2024 Chevy Silverado. Your accounts your current liabilities this year decreased to $41,066. Just to note that the accounts payable decreased down to what I would call as normal, $7,165. The previous year's $32,000 balance had $24,000 in costs in there for the riprap project. So overall, the net position in your water fund decreased to $3,163,936. So I'm not going to tell on your balance sheet there. The nitty gritty that comes down to your water fund is really your P&L. Overall, your revenues stayed pretty similar, hovering in the $540,000 ranges. Operating expenses this year increased to $769,983 from the prior year $696,560. Some of that is in your salaries. Overall, there's just stemming from raises. PERA looks a little funny because of adjustments to PERA because this is a proprietary fund. This is on the full accrual basis. So your funded, unfunded, net liability, all that stuff gets affected here. Your PERA gets affected here. So actually you did send 7.5% of your salaries here to PERA, but it is actually lower than that on your P&L because of those adjustments that are needed. Operating supplies this year increased to 72,910 from the previous year's 48,619. You had some manholes that were less than the capitalization policy, chemicals, meters, curb stops, etc. that all get put as supplies. Repairs and maintenance this year increased to 126,238 from the prior year's 106. Biggest thing in there is that you guys had paid for the rehab of 97 manholes in 2024, which is pretty costly. Professional services this year decreased to 8,949 from the previous year's 34,343. The previous year had 21,000 of cost to the DGR for wastewater treatment studies. Essentially, we started capitalizing those for you guys as a idea of construction and process. So when the future water sewer project goes through, it's getting capitalized as part of those costs going forward. As I said, in the general fund, janitorial, everything was paid for out of the general fund in the past, and this year there was some allocated to the water fund. And then the depreciation also increased this year to $207,872 from the prior year's $175,031, and that depreciation is increasing essentially because you have so many new asset additions recently that depreciation number is increasing so much. So overall, there's an operating loss this year of $221,454. The previous year's operating loss was $153,289. You did sell that sewer back trailer for $50,000. So that gain on disposal of capital assets, $22,030. Doesn't reflect the full $50,000 you sold it for because that asset was not fully depreciated. So actually the gain is only $22,030. The non-operating expenses, there's nothing this year. Last year, that $7,000, like I said, that's those special assessments. Actually, those lots were owned by the city essentially, and they're on North Tamarack on the hill, and essentially deemed that those lots will never sell because it's on the hill part of it. So you guys wrote those off last year. So overall, that leaves a loss before transfers and contributions this year of $137. And then per your budget, you transferred $12,500 to the general fund and $29,895 to the GO 2018A fund. So overall, there's a net change in position or change in net position of $178,963 loss this year. And then when we hit the next page, it is your cash flows for your water fund. And I hate being the person who's going to tell you to do this, but as you can see in 2024, you actually are losing money in operations. And on top of it, you're transferring money out of the water fund. And on top of it, your acquisition of capital assets has been pretty hefty, $490,000 in 2024 and 2023. So my lecture on this is the water rates need to be increased in the city. And like I said, I hate to be the bearer of bad news, but that's going to be my news to you today. That's kind of why I want Blake here to cover that, because that's something you guys do need to discuss going forward.
It's not new news for them. So.
Okay. So you're hearing it from me now. So then you're not the only city who gets that lecture.
Well, this is perfect because now we can just tell the public that
It's
you're
my
auditing.
fault. Yeah, it's Katie's fault.
Highly recommend.
Blame Katie. But like I said, these guys during our meeting, essentially all of my cities have increased their water funds one way or the other because they all have infrastructure, either large repairs going on, projects coming up, and what they're doing is just adding a line item on their bill, like infrastructure improvement fee, $5, stormwater maintenance fee, $5. They're doing flat rate stuff. It's up to you guys how you want to do it. Some are doing just increase in water rates overall. And these fees, like I said, it's across the board. And I will note that you guys or the city of Slayton is the cheapest utility bills around here. So if you have people start complaining to you, tell them to go look at other cities around here.
It's fake news.
So again, you don't need to discuss rates or anything with me today, but that is going to be my lecture to you guys, is to start building that fund back up. And essentially, because if you go back to page 80 on excuse me, I'm not my page. If you go to the balance sheet, wherever that was, 91, so the water fund. You can look there at the net position at the bottom. So of your net position, yes, you have it looks like a healthy net position, 3,163,936. It's essentially all tied up in fixed assets at this point. So 2,817,104 is in fixed assets. Cash in your water fund at this point is down to $346,832 at the end of 2024. So yeah, enough on that. So we'll go back to you.
Yeah,
gotta go like
I don't know what your thought is, just kind of what you're seeing trending and nothing changes. A little bit of an idea of what that shortfall is. And then what is the story with, I mean, we talked about doing a little bit of that water study and nothing has came of that.
That's a good question.
Those are two
That's
things.
good.
Because
What was the first question?
well, as it sits, to make basically everything whole, where should we be at? And then the other question is, where are we at with that stuff to
I
decide
think
if,
the answer to your first question is going to be in the second, the result of the second.
yeah, but that's what we've been waiting for 2 years for that. I mean, essentially.
so all those DGR costs on all those like studies that you have been doing last year, it was expensed out in your guys' stuff with the idea of who knows. This year we're like, well, it sounds like we're probably gonna have to happen. So we started capitalizing it, but so essentially even 100% of those DGR costs this year aren't even reflected in your books because construction and process doesn't get depreciated until it starts. So you're gonna have all these costs of DGR going out, or all your feasibility studies, or all that stuff going out the door, cash stuff door, but you're not gonna see it reflected in your profit and loss either until it starts getting depreciated. So fictitiously you're gonna want to build your books even more than what it is because you have more money going out the door than you're seeing in your expenditures on your as far as rates go, I'm not going to tell you a rate. That's
No, I'm not expecting you to do that. I'm more interested in the numbers to make. I can use a calculator. The numbers to make things whole, like how much
Well, you
historically
take it
over
on 1,000 households, it's about $25 a month. Cause it's 225,000.
Just in the operating cost.
Right.
And you really
for easy math.
Yeah.
you really are looking at, are you trying to pre-build for this future project as well? I mean, because the last thing you want as well is this project to come about in 5 years and then all of a sudden, oh, we're really short and hey, your water bill goes from $33 to $133 because we're trying to cover this bond now.
And that's what we talked about is, is phasing it. We talked about it, but I mean, yeah, there's gotta be a starting point, if it's $25 a month or whatever, then it's gonna be, next year it's gonna be $32, and next year it's gonna be $36.
In addition.
Sure.
Yeah.
But that's a
So whether, so let's just say it's $50 and $75, it might be $82, it might be $89.
but that's a workshop.
Yeah. Well, I mean, totally.
But to answer your question, I mean, in basic math,
Yeah.
to get it to zero, if you figure 1,000 households, it's $25 a month.
And I think I discussed it with you. I know the discussion happened in our office as well. Is part of that too is you are building your general fund enough lately that you're transferring XYZ dollar amounts over to capital outlay. Maybe change your allocations on some things if you feel like you're going to have city residents complain too much about a bill being increased, that maybe Jackie's salary be cut a little bit out of here and goes to your general fund. You know what I mean? Just some of the allocation stuff too will assist in a little bit. I'm not talking millions of dollars in infrastructure, but same with like you had that 5,000 janitorial that's always been out of the general fund to allocate $5,000 to the water fund. Now that puts your water fund $5,000 more in the hole when you had money in the general fund to cover it. That type of thing. But that's again, I'm not fun, so it's up to you guys. But yeah, I'm not gonna cover anymore. So where are we at? 81
81.
on. Yeah, it's pretty cut and dry after this one. So all right, page 81 is your Maple Avenue Improvement Construction Fund. This fund was started in 2023, completed in 2024, so there is no asset liabilities or fund balance left in this one, because the project is done. So page 82 is the start of the P&L here. So essentially, the Maple Avenue project, this year's cost was $496,822. Previous year's cost was $13,237. Getting the project started with some engineering fees, professional fees, etc. It cost $28,269 to obtain your bond or your bond issuance cost. So overall, the expenditures in here were $525,091. Your bond that came in was $550,000, and so there was an excess of bond over the costs here. So you essentially had to transfer 11,672 over to your 2024 bond to zero out this fund, or this construction fund is now done. Page 83 is your broadband infrastructure construction fund, same concept. This project / grant is done in 2024, so there's no assets, liabilities, or fund balance left. And then page 84 is the P&L on this one. So this one is, again, the other majority of your federal aid that is causing your single audit. So your federal grants and aids this year was $1,278,623. Previous year was $1,407,361. The total grant used between 2023 and 24, I believe, actually was below the 100% allocated because you did not use 100% of the administrative side of that. So, which is just fine. It didn't cost you guys anything, and that did cost Woodstock anything. So, that's essentially covering all of what's your administrator over there? Jeannie.
The housing partnership.
Housing partnership, Southwest Minnesota Housing Partnership cost.
This was a gift to me.
This thing over there. So yeah, the administrative side of the grant that wasn't 100% utilized was just because of that grant reporting that you guys were using here. The Southwest Minnesota Housing Partnership cost less than allocated. It's $210 spent in advertising and publications, and overall the rest of it was spent in your broadband infrastructure improvements, $1,257,805, professional fees of $14,313. So overall, there was a excess of revenues over expenditures of $6,295 because they allocated that money to cover Josh's administrative costs. So because of that, you transfer that money back over to the general fund to reimburse his time, essentially, that the grant covered. And so this each year, the fund balance ended up at zero because of how this grant is operating.
Because the single, that is purely year by year, right? There's no lingering.
Nope. So it's $750,000 of federal funds expended, not when you receive the money, but when you spend the money. So
So we probably
maybe won't need it in 2025.
I don't think so.
Now sidewalk grants done and stuff.
Right, small cities grant is not that big.
So unless you have something come through, you may be back down. So there's 3 levels of audits. There's a normal audit or general audit. There is a yellow book audit, and there's a single audit. You guys are at the highest level of the audit because you did spend the $750,000 of federal funds the last 2 years. It will taper back down to a yellow book audit next year, and the only reason you have to have a yellow book audit is because you guys have a grant that, or a bond that requires it. Essentially, we do almost the exact same thing, except we don't do a few of the reports in the back because we don't have to report on the schedule of expenditures of federal awards when you don't have the federal awards there. But the yellow book audit, essentially, we still are reviewing your internal controls. So when I have those internal control reports at the beginning that I talked about, that still is covered in your yellow book audit. A general audit, we don't need to look at your internal controls, and I would not report that to anyone except you guys, where these ones get reported to the state can see it. So, or in this instance, your bonding agency apparently wants to see it. A lot of the bonding agencies have gone away with that because yellow books do cost quite a bit more in audits as well, because we're doing more work. So, a lot of those bonding agents have gone away with that. I think the last one I see that you guys have it for was your 2018 A bond. I don't believe your 2024 one does. So that's a 10-year bond. In 2028, you'll be done with your yellow books too, maybe possibly. And at that time, when you can have your other funds come in.
No, that's not a 10-year bond.
It's not a 10-year.
I think it's a 20-year bond.
Is it? So you guys have yellow books for quite a while then.
Lucky you.
Yeah, it's okay. Page 85 is your TIF 2. This one didn't really change at all, $1. The only thing that's coming in TIF 2 is some lingering property tax monies, or TIF monies, I should say. So, if you flip to page 86, you can see that there is $1 TIF money that came in 2024. I don't really know how much lingering TIF money is out there. That is something that the county does not report to us in our confirmation that we get from them. But I'm assuming if you only get $1 this year, it's not very much. And I believe probably most of that stuff, I don't think you have very many delinquent TIF 2 people.
No.
So,
No.
not to say I can see every single person, but I can see I can see the delinquent accounts coming in, and they're not
Honestly,
in that area.
talking with Heidi before about this, that $1 is, it's not even truly delinquent. It's like calculating rounding errors on their system that they catch every. Like
It very well could have been even like a one little bit late something rounding thing, and then they did get it to you till January 2025.
Well, it's like 4.5 cents over the last 10 years, and they only cut the check if it's a dollar type of, because it's such a little.
So this TIF closed in 2023. As you guys are aware, you guys designated, it sounds like, to get this back to the county and then reallocate it back to the city to bring to the Wonder World project. So essentially these funds are gonna kind of hang out there until that all transpires. Otherwise it's just hanging out there, but the TIF is closed for 2023, or in 2023 then. Page 87 is your
certified, not
certified.
decertified.
Decertified.
The fund isn't closed.
Yeah, the fund will stay open until Maple, or
The district is certified.
stay open until the funds get transferred. After that, it will close. TIF 4 or 5, TIF 5, that would be as a 5. Cash and checking is $62,054. This is where, if you switch to the next page that we're talking about, you are collecting TIP revenues in here. So in 2023, you collected 21,014. This year's 26,205. You are paying Eilers a little bit in professional fees for that TIP reporting each year. This year was 2,214. Last year was 1987. So overall, you have a net change in fund balance both years. This year 23,991. Last year 19,027. Actually, there was revenue stemming from 2022 when this TIP money started coming in. So per your bonding or your TIF reporting, they said that 62,054 can get transferred to the 2018A going forward. So we will do that as an annual thing going forward. Because Josh did that transfer in 2025, we're going to leave the funds as is for 2024. Like I said, it's just hanging out there. Page 89 is your TIF 6. TIF 6, essentially, it has a checks written in excess of bank balance and then a restricted, or it's actually going to sign it.
References the gold livings.
Yeah. So TIF 6 is hanging out there at a loss, essentially. And then if you flip to page 90, there isn't much going on in TIF 6. You did just get a little bit of money coming in, $99. There must be what we deduced is maybe one property or one parcel in this TIF district that is collecting revenues on, but because there's no other lots getting money collected on in the TIF revenues, there's not going to be a lot.
Collecting our own, or capturing our own increment, because we own the entirety of this TIF district.
And same with your other TIF districts, then you're paying professional fees for TIF reporting. This year's 2,214. So actually there's a net change in fund balance of a loss this year of 2,115. Last year, same thing, 2,317. I believe we just talked about the fact that if this doesn't start jiving, you guys will have to decertify this TIF and then pay the funds back out of this somewhere, somehow, some way.
There's a couple things going on here. Number one, the 178.54 fund balance is the entirety of acquiring the property, demolishing Golden Living Center, the environmental work that we had to do with the tank leak,
But the
And-
80,000 or whatever it was from the state also came into this, correct? I believe.
Correct. So if we don't have anything done by, I believe, the middle or end of 2026, the state comes knocking and says we want our $82,000 back. And then if a project isn't started within the TIF district within 5 years, then the state comes knocking and says, well, you should decertify that TIF district then. Now, the certification of the TIF district didn't happen until, I want to say, a year or two after all the demolition and stuff. So a little bit longer timeline on that. But yes, it would be super ideal if things would happen there. So
Because essentially, if you guys pay back the 82, that's going to go in here too, and you're going to be sitting at a $250,000 fund deficit that needs covered from. So.
water fund.
So the water fund should be operating on its own. Yeah, and we already covered the water fund, so that's the last couple of pages there. Do you guys have any questions on any of the stuff I covered?
Sorry, go ahead.
Well,
Somebody said something.
in other words, we have like 2 actions.
Oh, that's what I was gonna say. Perfect.
What's the thoughts of that? Just transfer that amount into the capital outlay like they normally do.
In anticipation of this payment that we're gonna potentially have to do on that TIF 6, is there some, I mean, can you not do the transfer and have it allocated kind of there? I mean, I feel like if we're gonna have this big amount of money, that's not, then we gotta figure out.
I don't know if Eilers, Allers, however you pronounce it, will allow for it. I have most TIF districts don't allow for any sort of revenue streams to be in the TIF district aside from the sale of property and the TIF revenues until something happens with a decertification on it. You would have to check with them to see if you'd be able to transfer the money from any other fund into there. Is typically how I see that.
I'm just asking.
Like I'm not like some TIF expert either on that, but I do know like even one of my cities that they actually collect property tax revenues and their TIF district, not TIF revenues, but general ad valorem, and they actually have to transfer that money back out into their general fund, even though that's where they budget for it to come in, because they cannot have anything but TIF revenue in the sale of property to cover the bond payments, but it's essentially not covering the bond payments because then it has to get transferred back out to their general fund.
Yeah, they're double allocating the same revenue.
Yeah.
Because the TIF money is the city, the county, and the school districts ad valorem dollars.
Yeah, everyone's covering those versus the TIF district.
Right, so then they're budgeting again on the revenue of the ad valorem dollar, budgeting the same money twice. Well, whatever.
I'm not the budget police either, but just knowing that I know that their TIF reporting agent is very, very strict about that. That's the only revenues that can come into there.
Fair.
I'm assuming all TIF districts are the same if they're.
Well, I think from what I understand in that aspect of, but there's a lot of other minutia rules depending upon which year it was created.
Yeah.
Governing uses and things like that. So
beyond my job.
It's not as bad as it used to be. There was like a period from, what was it, Chris, it's like the mid-90s for about 8-9 years. Every year it was dramatically different.
I guess my suggestion on that at this point would be to transfer it to a different fund at least, and then if that's your guys' intentions, to just know that that was your intentions when you pay it, because I just would hate for you to do a transfer to somewhere that can't be transferred to.
I just was asking questions.
And your TIF reporting is actually due, I believe, July 31. Is that not? So so it's done. So like essentially you can't transfer it in at 2024 to it because your TIF reporting has already been done.
Yeah, it's due by August 15th. No, it's due at 7/31. You're right. So it was submitted like a week.
They were submitted with preliminary reports essentially. Cause we didn't give you your final draft reports to be able to submit that either. Something you may want to.
Well, those actually aren't required for the TIF reporting. They just want it's
Recommended.
required for Ehlers because they want to pull all the trial balances and everything out of it. But with all the other documentation that I give them, they're able to
Do what they
see
see.
the report. Yeah.
So we need a motion to transfer the 126, 135.
Yes.
To capital improvement fund. I would move.
Okay, is there a second for that?
Second.
Any further discussion? If not, all in favor say aye. Aye. Opposed, no motion carried. All right, then the other one is to adopt the presented and amended 2024 audit.
An authorized submission.
Yeah, an authorized submission.
So moved.
Your second. Okay, any further discussion? Not all in favor say aye.
Aye.
Opposed, no motion carried. Okay,
You're welcome.
From OSA today. Hey, reminder, it's
Stuff's due.
8:15.
Yeah, so this is actually due August 15th. Your reporting to the feds is due September 15th or September 30th. So we will have this to next week for you to review the final before we submit anything. But yeah, Kim already pretty much has it done, assuming you guys were gonna approve the transfer today.
We did it, we were told.
You did as you were told, but yeah.
advised.
Advice.
So yeah, I will have that to you guys sooner than later, and then you'll get your full bound reports. Alrighty, let me know if you have any questions.
Thank you.
Yes, you're welcome.
What's left of the list? It's not dark yet.
That's true.
All right, we're gonna go back now to unfinished business, and Josh had put together a draft on the cannabis ordinance to reflect the directions that we provided him with at our prior meeting.
Thanks. So it's a little bit glitchy here.
Did we like exceed a time or something like that?
No, I think we may be audio only on our stream for the rest of the meeting, because as soon as I hit my laptop off that camera, I don't. Anyway, so this is, as Myron said, the unrefined draft. What would be changed is adding chapters and incorporating it into our existing code in an appropriate place, and not just plopping it down at of anything where, like, we already have liquor and tobacco, so it would be in that same area of the ordinance. And so the goal of this walkthrough is kind of just the stuff that we went main point by main point at a previous meeting. Did it get translated by me correctly into this draft?
And I do have a fair number of questions. On the second page on enforcement, section 1.4, it refers to any violation of the provisions of this ordinance or failure to comply with any of its requirements constitutes a misdemeanor. It is punishable as defined by law. Misdemeanor is 90 days in jail or and or $1,000 fine. And then in section 2.1, it references any state licensed cannabis retail business that sells to its customers or patient without valid retail registration shall incur a civil penalty of up to $2,000 for each violation. So I feel like we're mixing criminal and civil on this, and maybe this is how it's done. But
that is how it's done. So that language was not touched by me at all. That is right out of the state's model ordinance.
Okay, and then just like a couple of these notes issued by the cities, by the Slayton.
Yeah, that was a find and replace issue there.
Right.
That,
Just like I said, just clarifying that criminal violations is different. So in theory, then there could be a criminal violation as well as a civil penalty for violating this. That seems, okay. If that's what they're doing, that's what they're doing. My next question, not to take over the show here, but I did go.
I was looking forward to you doing this.
Sorry. 2.3 registration and application procedure. The first line says the city of Slayton shall not charge an application fee. Then the next line says a registration fee as established in Slayton's fee schedule shall be charged.
Yeah.
So there's references to application fees and registration fees throughout, and it doesn't seem to be consistent. I'm not sure.
It's not consistent because the state's the enabling statutory reference, there was some political debate there of you can't have an it's semantics is what it is.
No
So
kidding.
you cannot call it an application fee, but you can charge a registration fee. And then the state statute also states you can only charge up to the 500. I also find it interesting that then the renewal is 1,000, which is also in state statute, which makes no sense to me at all. Typically, the initial application
It's higher.
slash registration fee would be
Absolutely.
higher because that's when you're doing all your investigation and
Right.
background check and
Right.
everything. So it is confusing and backwards in my opinion, but
Yeah, so, and when it doesn't make it clear, shall not exceed. So when, we have to have some more work to do as far as our fee schedule.
setting the
and
registration fee
setting all
in our
those,
fee
but-
ordinance, yes.
But I
updating
mean,
our fee ordinance.
and this is how the state statute looks too, that it's less to do the initial registration fee and more for the renewals.
Yeah, because this was another section that wasn't any modification by me, other than putting Slayton in.
It makes no sense.
Do
Do we have to follow it?
No.
I mean, that makes no sense.
Yeah.
It's absolutely, it's nonsense.
Right.
It should be the other way around. If you want, depending on what we want to charge, whatever, the higher fee.
The easy thing would be to delete the first sentence, because if you're not going to charge it, there's no reason to reference it in
Absolutely,
the
you could just
ordinance
delete that.
language.
I was confused between, the reference between application and registration, so. And then,
In fact, it even utilizes the word applicant for the registration fee. So you can't charge an application fee to the applicant.
But you can charge a registration fee.
Right. So you're
well, and then later on in section D of 2.3.2, the application fee shall be non-refundable once processed. Well, there isn't an application fee.
Yeah, if you can't have one.
Right. Right. That's up here.
Yeah.
So that.
Well, if you can't charge a fee, then I guess you can't.
Or so was it that intended to be the registration fee?
I don't know.
I mean, that's
so there's just some real
inconsistencies.
Very much so.
Yeah, that
I think it definitely should be definitely, because I mean, remember when like our liquor license, I mean, we've had people that want to get prorated, when they when they closed business or whatever, they wanted some of their money back because they only had 6 months of their liquor license or whatever. So it definitely should say registration.
That's why I'm bringing it up. I also then section 2.4.1 renewal fees may charge renewal fee for registration starting at the second renewal. Well, I thought that was already
Called on.
kind of yeah. So may charge, will charge, shall charge. I mean, what is it? So see where I'm at.
Yep.
So that was a question. Then just the meeting the city of Slayton in their 2.5, there was adding the city out there. The civil penalties, I was confused about that. It was referenced again in the civil penalties, which is, it almost seems if it's geared more toward the, I don't know. Yeah, I think this will need to be looked at by council too. And then, again in section 4, the temporary cannabis events section, registration fee is referenced and shall require an application for the temporary cannabis events. And we obviously are going to have to look at those fees if there's some temporary, which may be different than
I'm gonna check to see if we have to allow temporary cannabis events. I think that may be a section that we. Right.
Yeah, and then this one just didn't have, it's an insert staff department elected by the will approve it, you know, should have Slayton City Council on there.
Oh,
You
yeah.
know, there's just several of those.
Is that something the city does not have to allow? Is
That's what
temporary use?
I can't remember, so I verify that. I want to say that we do not have to require that, so we could just chop that out.
Yeah, and
I
then
don't see any reason. why
when they
we
reference
have
application fees again, and
At
then
this point.
this section E up here.
Smokapalooza.
That's the weed
Right, Smokapalooza.
A
Might have
request for
heard something new, yeah.
meets the requirements of this section shall be approved. That sentence makes 0 sense.
House of smoke, it's right there.
And then the next one's number 5. I don't know. 5. Maybe this whole thing will just get 6 on there. So.
I must have done some
Yeah,
backspacing and then that's formatting.
Yeah,
all
that's-
messed up.
that's-
That's supposed to be enough.
oh, maybe it's just F, yeah. But that E sentence doesn't make
Yes,
sense.
yeah.
So.
Look at what other cities have done too in the area. I didn't, when the state gives you a model, you tend to go to that, but I don't know how closely other cities follow the model in terms of formatting. Now the meat of it, the distances away from certain establishments that of course a lot of those are just defined by statute and what you can and can't do, but yeah, this is not the most user friendly reading.
To me, that, in that 2.41, that A doesn't make sense to me. About
Right.
essentially May.
Yeah, I agree. I circled that too. It's like,
Yeah.
hey, what does that mean?
May,
It was previously said that there was gonna be,
to me, that's a shell.
Yeah. Yeah, this is not a.
Have you looked at any of the stone or sure these guys that
Yeah, I think they
already done these?
Worthington is that.
Yeah, that's what I just said over here is no. Well, yes, I have initially, but the analysis that I have not done is how closely does the state's model ordinance mirror what these cities have in their final approved product?
Right.
What they adopted.
Right.
Are they all as messy as this? Are they
Right.
very
Yeah.
different?
Be
If they're
interesting.
different,
Be interesting to see.
who did they talk to? Is there
Right.
some
Right.
buddy, consultant, counsel that I can talk to?
Oh, maybe it's a percent attorney.
Some of them haven't touched it. Laverne still doesn't have their pipestone just, I want to say, in
Just
February. Worthington, I do not think has one yet. Well, yes, they did. It just
yeah, they said they did it on. I heard on the radio.
well, yeah, because they approved that Jimmy John's location.
Right.
The state has approved that location, so they need to get theirs done if they don't already have one.
I think they second.
And Marshall has had theirs for a while. So is Wyndham. Wyndham's really short. So, okay.
So what's our direction here?
I have homework to
Okay.
yeah. I have cleanup homework to do, and I have research homework to do to get it into a acceptable
And I
product.
run through by Travis.
Oh yeah,
Just to see,
yeah. You're the one that's going to be signing a criminal civil complaint.
Yeah,
If we, pass this, is it
Absolutely.
enforceable? Is it
Exactly. All right. Is there anything?
And I think we need to have that before we, we're not looking at passing anything until it.
Oh, we have to have,
Oh,
we
100%.
have to have hearing
On steps.
that too, so. Yeah. No, we definitely want to have this in the best form possible before we call a hearing.
I have nothing else.
Okay, with no further business, is there a motion to adjourn?
So move.
Second?
Second.
All in favor say aye.
Aye.
Meeting adjourned 2024.